Today I'm going to talk about seller concessions, what they are, lending rules, and options for spending them. I'll walk through a variety of alternatives and considerations for each, and then I'll give some examples so you can see how the numbers play out in the real world. And whether you're a home buyer or a seller, understanding concessions is just so important. Every dollar of concession comes at a fixed cost to the seller, but how concessions are applied for a buyer can vary a lot, as we'll talk about, and there's no one-size-fits-all answer. But once you understand the options, you can be strategic. If you're a seller, you can offer targeted concessions to minimize your costs while maximizing the benefit to your buyer. And if you're a buyer, you'll learn how to get the very most bang for your seller's buck for your goals and your situation. But first, what are seller concessions? So a concession is any agreement where the seller covers something, costs or otherwise, that would typically be a buyer's cost. It would typically fall to a buyer. If you're wondering why a seller would make a concession to a buyer in the first place, there are a lot of reasons. In a buyer's market or at a time when the supply of homes exceeds demand, sellers can use concessions to get a buyer's attention or to encourage them to buy their property instead of all the other similar homes on the market. And no matter the state of the market, some homes just don't sell right away. Brokers sometimes call a home sitting on the market stale inventory or stale listing. Offering concessions can bring a buyer and really cost the seller less than just sitting around and waiting while they continue to pay their mortgage and taxes, insurance, and utilities, and all the other expenses for upkeep. And concessions are also a way a seller can avoid price reductions. Certain sellers are sensitive to keeping the sales price as high as possible, and sometimes this is just their ego talking. But if you're buying a new home from a builder, you'll find they'll do almost anything to keep the sales price up. Selling a home at a reduced price could bring down the price on every other home in a community they're trying to sell homes in or create problems with appraisals. A property's condition is also something that can bring concessions. No home's perfect, so even in a hot market, even if you had to bid over the asking price to outcompete other buyers, you might be able to angle for some concessions after your home inspection. And if someone is selling a fixer-upper, sometimes they'll preemptively offer concessions right up front to offset the cost of repairs that they know their buyer is going to need to make. And some sellers just want to unload a property as fast as they can. Maybe they got a job in another state, or they're going through a divorce, or they have some other external motivation. Whatever the case, a seller in a jam may offer concessions just to get their sale wrapped up quickly. But whatever the reason, what's the best way to spend seller concessions once you negotiate for them? To answer that question, you need to get clear on your goals. Are you looking to reduce your upfront cash, minimize what you need to bring in at closing? Or are you hoping to get the lowest monthly payment possible? Or do you just want the best deal regardless of the form it takes? You want to think about these questions and try to prioritize them because there are definitely trade-offs. Sometimes if you reach for one goal, it means you have to pass over another. So let's get to it. The options for talking about concessions are going to run from really obvious stuff to some concepts that require some explanation and context. And if at a glance this list includes a little bit of unfamiliar jargon, don't worry. I'm going to decode the jargon for you, and I'll break down each option, and I'll also share some numbers so you can see how these things play out in comparison to one another in the real world. So in the end, by the end of this video, you should be able to pick out the strategy that's exactly right for you and your circumstances and your goals. And as I get rolling, I want to take just a second and ask you to take a moment to like and subscribe. That'll let me know you found the video helpful, and it'll help my channel grow. And if you're in the market for a loan or a lender, maybe your search is over. I lend in all 50 states, and I'd be happy to connect and help you get into your new home. So let's get to it and talk about what is probably the first thing that pops to mind when you think about negotiating to buy a home, and that's a price reduction. Just getting the seller to knock something off the price is kind of obvious, and it also feels good. It feels like you won something, and it's not very hard to get your head around. There's a simplicity to it. And there are definitely circumstances when a price reduction is the best and simplest option. A lower price will impact your down payment and impact your monthly payment, But unless you're making a pretty big down payment, you might be a little surprised to see just how small that impact is. And I'll share an example in a minute here so you can see what I'm talking about. And sometimes there are some quirks of psychology that kick in, other than a minuscule difference in the fees and maybe some taxes that the seller pays. Any concessions affect the seller totally identically. $1 of concession is just $1 less they'll clear at closing. But some sellers get really attached to getting a certain price for their home. And this may be a bit irrational, but a seller dead set against coming down in price can sometimes be perfectly willing to offer a concession in some other form. And another somewhat obvious way you can ask for concessions if you're working around a price reduction or you want something else is to just ask the seller to make repairs. Repairs made by the seller address property issues without dipping into your pocket after closing. And in a sense, because they're really built into your purchase price, you're able to finance them. You're financing these repairs and spreading them out over the life of the loan of your mortgage. And if you're tight for cash, this can really be a game changer, especially if you're buying a bit of a fixer-upper. But even if you have the cash to make repairs after closing, you might want the seller to assume the risk for certain types of repairs. If an underground heating oil tank, for example, is leaking, the cleanup can get really expensive, especially if the oil has leaked into the water table or a neighbor's yard. Or maybe there's some termite damage or something else, dry rot, but the extent of the damage and the cost to fix it is going to be a mystery until the contractor gets to work. These are times that it might make sense to ask the seller to take care of these things so that you aren't taking on the risk of an unknown repair. And then if the appraiser notes any repairs, your loan can't actually close until the repairs are made and re-inspected. So this is a time when you really would have to negotiate for repairs with your seller to get closed. The notable exception to that would be if you were purchasing a property using a renovation loan. That's kind of a topic for another video. But there are some downsides to asking a seller to make repairs. You're going to be ceding control over the process to the seller, and this means, they might get the opportunity to cut corners or make some choices that you just aren't crazy about. And you and your realtor can specify details about the contractor or the materials, but that's a lot easier to do for repairs that involve something simple, systems like the roof or the furnace. If it comes to repairs that involve aesthetic choices, tile and paint and finishes, you really might want to maintain more control and handle those after closing. But by far, the biggest reason, the main reason to ask for some other kind of concession besides repairs is just simplicity and timing. Coordinating repairs prior to closing can be complicated and could delay your closing, and you may be okay with that, but most sellers just want to get on with it and get closed. And if they wanted to be making repairs, they probably would have made them before they listed their home for sale. You'll even notice a lot of fixer-uppers get listed for sale as is, which is a signal, big sign that the seller isn't interested in or willing to make repairs prior to closing. So what would be some of the quicker or simpler options to avoid asking for repairs? Well, one is to just ask your seller to pay a credit to your closing costs. This is a type of credit that happens totally seamlessly and totally on paper, so it makes it really simple for you and the seller. At closing, some of the seller's proceeds are just applied to your costs, which lowers your upfront cash. So if you're stretched thin for money to buy, asking the seller to pay closing costs may not only be appealing, it could be even necessary to get you into your home, could be the only option. Or you can take that savings with the seller paying your costs to make repairs after closing or cover moving costs or just keep a cushion of cash around after you move into your home. And seller credits can also be used to stretch your budget. The money that you're not spending on closing costs can shift over and be applied to your down payment. The bigger your down payment, the bigger your purchase price can be. And I'll break this down and show you how this works with an example in a minute. Now, you always want to negotiate for seller credits, and I can't emphasize this enough, with a really clear understanding of your loan. Closing cost credits are limited by loan rules and by the actual amount of your costs. If you negotiate for a credit that's more than your actual costs and more than loan rules permit, your seller is going to get to keep the difference. Your lender will cap it at closing and you won't get the benefit of all of the credits you negotiated for. So work closely with your lender and make sure you don't wind up leaving any cash on the table. Now, when I talk about closing costs, that's a big catch-all term for all of the expenses that are associated with your home purchase over and above the down payment that you're paying. And for a detailed breakdown of what to expect from these, I've actually recorded another video. I'll link that above so you can check it out. But our next three categories are actually a subset of closing costs. And if you've hit that situation where, good for you, you negotiated a really big seller concession, but it's more than your actual closing costs, these options are a great way to beef up those expenses so that you can spend a bigger credit, get a benefit for it, and not leave any money on the table. The first of them is a single mortgage insurance premium. If you put less than 20% down on the purchase of a home, you'll be required to pay for mortgage insurance. And traditionally, mortgage insurance is included in your monthly payment. But single MI is different. It's a one and done MI premium that's paid as a part of your closing costs. So if you want a lower monthly payment, using a seller credit to kind of rip off the MI Band-Aid can be a really good option. And monthly MI can be canceled eventually, but the worst case scenario for monthly MI is always higher than whatever the cost of a single mortgage insurance premium would be. And paying MI once at closing means there's not ever going to be a hoop to jump through or any costs or hassles to deal with to cancel mortgage insurance. But single MI premiums are non-refundable. And just because you're getting a lower initial monthly payment, that doesn't automatically mean that single mortgage insurance is going to be the lowest overall cost. As a general rule, if you think you're going to have your loan for a really long time and you don't expect your property value to be going up quickly, single MI can be a good deal. But over a shorter time horizon, monthly MI is probably going to be a better bet. So if you see yourself paying the loan off soon, maybe you're planning on selling, you just don't see yourself keeping the property for a long time, or if you're hoping rates come down and you can refinance, monthly MI is probably a better bet. And the same thing's going to be true if you think you're going to be in a position to cancel monthly MI pretty quickly. So let's say your property value is likely to go up fast, either because of market conditions in your area, or especially if you plan on making significant improvements. In these instances, you're probably better off just living with the monthly mortgage insurance and then canceling it as soon as you can. And to learn the paths to canceling MI as quickly as possible, you might want to check out another video that I'll link above. Now, discount points are another type of closing cost that the seller can pay for you. When your lender locks in an interest rate for you, you're also going to lock in an amount of points. Points are a fee that's paid as a percent of your loan amount that directly influence your interest rate. They go together. You can't talk about one without the other. If you picture a seesaw, paying more in points will lower your interest rate and vice versa. You can, in a way, think of discount points as just being prepaid interest. Now, using seller concessions to pay points will create savings in three ways. A lower rate, of course, means you're going to have a lower monthly payment. But that lower monthly payment also includes more principal and less interest, which means you're going to be paying your loan down just a little faster while writing a smaller check, which is actually kind of a neat trick. And then, of course, a lower rate is going to reduce your interest costs over the full term of your loan. So if you keep your loan for a long time, the savings can add up. It can be tens of thousands of dollars. And if you itemize on your income tax returns, there's a bonus benefit you'll get. You should be able to claim a tax deduction for the cost of points when you file your income tax return for the year that you purchased your home. And that's true, believe it or not, even if the seller paid the points for you. Now, I definitely want you to get your tax advice from a tax professional and not me. It's a little asterisk, I am not a tax expert. Now, as with single mortgage insurance, discount points are non-refundable. It can take time, years even, for the savings that you get from discount points to equal, cover, and then exceed the upfront cost that you paid. So if you aren't planning on keeping your loan long enough, if you don't keep your loan long enough to save back at least what you paid up front, concessions that are allocated to points could go partially, even largely, to waste. And this may not feel like a total disaster if you're spending the seller's money on them, but with all the other options that you have for concessions, you want to be strategic and make sure you get the best bang for your seller's buck. So only pay points that you expect to get back, hopefully, and then some. If you buy at a time when rates are elevated and you're hoping to refinance before too long, you should probably only pay points that break even pretty quickly. And to help my clients with these decisions, I've put together a spreadsheet. This is a very spreadsheetable project, by the way. So the one I've built pinpoints the break-even point and long-term savings for any combination of rate and points, and it can make the decision really, really straightforward, very transparent. Now, if spending concessions on non-refundable fees like single mortgage insurance or discount points doesn't feel like the right thing to do, there's another option to explore: a temporary interest rate buy down. This strategy lowers your initial monthly payment without the risks associated with an adjustable rate mortgage, by the way. It's a fixed rate loan. And the most common version, there are a bunch of these, but the most common version is called a 2-1 buy down. And the way it works, for the first year of payments, you get to write a check every month that is based on an interest rate 2% below your actual interest rate. During the second year, your payment's based on an interest rate 1% below your actual interest rate. So you only have to start paying your full payment starting in the third year. And this sounds like magic, but it isn't. There's no sleight of hand. At closing, your seller deposits money with your lender that goes into a subsidy fund that exactly equals the amount of the discounts that you're going to be enjoying on your payment over those first couple of years. So every month you make a discounted payment, you write that smaller check, and your lender subsidizes your payment from the seller's money that they have on account. And once that money runs out, well, that's when you have to carry on making your full monthly payment at your true fixed interest rate. My company offers buy downs in a bunch of flavors: a 1-0 buy down, a 1.5.5 buy down, a 1-1-1 buy down, 2-1, and 3-2-1 buy downs. And if you're looking for the lowest possible initial monthly payment, a 1 or 2 or even 3% discount in your interest rate for the first few years can make a huge, huge shift in your payment. And your initial years of homeownership are probably when your budget is going to be the most tight. So having a little leeway to cover improvements, fixing things up, furnishings, any, oh my gosh, I didn't know I was going to have to fix that kind of expenses can really bring peace of mind. And if you anticipate increases to your income, or maybe you're near the end of the line with a car payment, or your kid's going to be out of daycare, a temporary interest rate buy down can nicely dovetail your mortgage expense as it ramps up with other changing cash flow situations in your life. And if you're buying at a time that interest rates are elevated and you feel optimistic that rates are going to come down and you'll get the chance to refinance to lower your rate before too long, the temporary interest rate buy down has a big, big benefit. No matter what, you'll benefit from every penny of the buy down subsidy. If you keep your current loan for the full term of that scheduled subsidy, you're going to get the scheduled discounts to your monthly payment. But if you refi or otherwise pay the loan off, maybe you unexpectedly sell soon or something like that, before that subsidy money runs out, your lender is going to credit the remaining funds toward your loan balance. This isn't mandatory, but most lenders do. So definitely verify with your own lender, of course. But if rates cooperate and you can refi before the subsidy fund runs dry, the concession the seller paid at closing can actually offset the cost of your refinance. But of course, you need to go into a temporary interest rate buy down with your eyes wide open. Interest rates are a wild card, and there is definitely not a guarantee you're going to be able to refi to lower your payment. So hope for the best, but make sure you have a plan and that you can afford that full monthly payment when it happens. And I also recommend stepping back to the big picture and thinking about this from a higher level, because a seller who's willing to pay a temporary interest rate buy down is also going to be willing to pay for your closing costs. Remember, $1 of concession is $1 of less money due to the seller at closing. They don't care what form you take it in. So if you apply concessions to closing costs instead of a temporary interest rate buy down, you'll have less money due at closing. And you could bank that savings, literally, and set up your own self-funded subsidy account. So instead of having money that's tied up with your lender, getting paid out at a set schedule, kind of locked into that set schedule, you'll have control over it. You can dip into it more flexibly when you need to. You can use it to subsidize your payments, but you can also pay for other stuff, and you can earn a little interest on it along the way. But if your seller is already paying for all of your other closing costs and you're looking for a way to spend more money, a temporary interest rate buydown can be a brilliant way to beef up your closing costs to spend excess seller credits in a way that you don't have to worry about ever leaving money on the table if, again, you can refi or you pay off the loan quickly. Now, homeowners association dues are another cost that can be covered by a concession from your seller. They're of course not applicable for every property, but if the home you're buying happens to be a condo or a townhome, or it's part of a community with dues, the seller can prepay up to a year of HOA dues. And you can also ask your seller for other non-monetary concessions. We already talked about one actually, just having the seller make repairs, but there are lots of other common non-monetary concessions and some uncommon ones. A seller could commonly buy a home warranty for you. That can defray the cost of repairs over the first year of homeownership when your budget might be the most tight. Or you can ask them to throw in personal property. That could be appliances, that's pretty common of course, but maybe a hot tub or furniture or a rug that perfectly fits the space, or that riding mower in the garage, or the kids' play structure out back, or whatever. Or does the seller have a membership to a community pool or a gym or a club or a golf course or something that they could transfer? I've even seen, less commonly, living things change hands. Plants, chickens, livestock can even be included in a home sale. And if you're purchasing a new home from a builder, again, you'll quickly learn that builders are really devoted to keeping the top of the line sales price as high as possible. So they don't want to reduce prices. It can negatively impact all of their future sales in a community, but they might be willing to throw in appliances or upgrades or other things in with your new home. So I promised to show some real world examples, and I'm going to do that, but before jumping into the numbers, we need to take a short detour and talk about some lending rules, because certain types of concessions are capped or receive special treatment or are otherwise limited by lenders. Some concessions aren't subject to any limitations. Lenders are not going to meddle in your negotiations with the seller when it comes to a reduced price or to repairs. But if you negotiate for repairs, your lender will ask for proof that they've been completed before letting you close. There are a couple of limited exceptions to this requirement. And the most notable of those is some tremendous flexibility that the VA loan allows when it comes to seller concessions. I'm going to talk about that a little more in a second. There are also no restrictions on what Fannie Mae calls sales concessions. And this really is kind of overlapping with those non-monetary concessions like the furniture or a riding mower or a hot tub or appliances or whatever. But there is a catch. The value of these types of concessions can affect the maximum amount, the loan amount that you can borrow. Lenders will only finance the value of a home, not personal property. So if you include, say, $10,000 of furniture in a $500,000 purchase, from a lender's perspective, you're really spending $490,000 on the house. And that means your maximum loan amount would be adjusted accordingly. Now, if you're not borrowing the maximum loan amount, if you're making a big down payment, that may not matter. But to make the necessary calculations, lenders need documentation for the value of whatever the personal property is that you've wrapped into the deal, and that can be a hassle. How do you determine what a used hot tub and riding mower are worth? So I recommend one of two things. If you're buying a home with a limited amount of personal property included, or the seller's leaving items behind because they're difficult or expensive to move, or they just don't need or want them, it's just sort of a hassle for them, let's say firewood or a hot tub or a pool table or furniture and linens in a vacation property, include them in your offer, but make it clear, put this language in, say that they are included at no value for the convenience of the seller. Or you can also avoid any potential issues by just writing up a separate bill of sale. If you transfer the ownership of the personal property separately on its own agreement and keep it out of the sales agreement, then obviously it is not going to be part of the loan conversation. So what about all of the other concessions that we just talked about? Lenders impose limits on these that vary based on the type of loan. Conventional loans restrict seller concessions on a sliding scale based on your down payment. The limit to concessions is 3% of the price if you're putting less than 10% down. With at least 10% down, but less than 25% down, the limit jumps to 6% of the price. And at 25% down or more, the limit is 9% of the price. unless you're buying an investment property. If the property you're purchasing is a rental, the maximum seller credit is 2% of the price no matter how much you put down. Now, FHA and USDA loans keep it simpler and more one size fits all. The maximum credit is 6% of the price. And VA loans are uniquely generous. They limit seller credits to 4% of the price, and that actually sounds less generous than some of the other options, but the devil is very, very much in the details. Credits for customary closing costs and what they call reasonable discount points aren't counted toward the 4% limit. So veterans buying with a VA loan can ask the seller to pay all of their closing costs plus up to another 4% of the price toward all kinds of other stuff. And that'll include some of the usual things that sellers can pay for as a part of other loans: permanent and temporary interest rate buydowns and property taxes, homeowners insurance, HOA dues, also the funding fee that the VA charges. And if that hasn't burned through the 4% and the seller's willing to pay more, then the VA will let sellers pay off a car loan, pay down a credit card, pay off a judgment, buy gift cards, appliances, a TV, even prepay a credit to a contractor for work that's going to be done after closing. So a builder could, for example, pay a credit to a landscape contractor to install a backyard after closing on the purchase of a new home. So let's put all these ideas to work and see how the numbers look when the rubber hits the road. So let's take a look at the numbers together. And I'm going to talk about single mortgage insurance versus monthly mortgage insurance first, and then I'll do some case studies to talk about what some of the other options are that we've run through and how they're really going to look as they play out in the real world. Now, when we talk about mortgage insurance, really when we talk about almost anything in lending, but definitely when we talk about mortgage insurance, context matters. There are a lot of things that affect what the cost of mortgage insurance is going to look like. So you can see here the assumptions behind the numbers that I've put together here. Even if your particular circumstances are different than this, odds are high they will be, the same principles are going to apply. Now, when we talk about mortgage insurance, comparing monthly and single mortgage insurance, again, what we're trying to do here is get the best bang for our buck for the concessions that the seller has agreed to pay to you. And so to compare monthly and single mortgage insurance, we've got to talk about what the premiums are. So for the example, using the assumptions down in the corner there, the monthly mortgage insurance premium with 3% down would be 0.34% of the loan amount. That gets multiplied times the loan amount divided by 12 to determine what that monthly mortgage insurance is going to be. And then a single mortgage insurance premium would be 1.4% of the loan amount, or $7,000. And you can see here what the other premiums would be. And I'll just say as an aside while I share these, that one of the biggest surprises I think a lot of my clients have when we start talking about loan options for the first time is how inexpensive mortgage insurance can be. You can see we're talking about under 60, even under $40 a month. And the single mortgage insurance premiums are pretty reasonable as well. Now, when we want to figure out what's the best option, how are we going to spend that seller concession as efficiently as possible, we want to start analyzing, well, gosh, what's our best bang for buck? And one way to start thinking about that is to calculate a break-even point. And we do that by taking whatever the single premium would be, in this 3% down example, $7,000, and dividing that by what the monthly premium would be, in this example, $137. And if you do that math, you'll get 51 months. So what that is telling you is the single mortgage insurance is the equivalent of what you would have paid over 51 months of monthly mortgage insurance. And I've done the math for all the other examples here, and you'll see that you'd be paying the equivalent of about 3.5 years of mortgage insurance, 3.5 to just over 4 years of monthly mortgage insurance to rip off the Band-Aid and pay the single mortgage insurance premium. That still doesn't really tell us which is the best bang for our buck. So now we have to think about, well, gosh, what's the other option? If you pay monthly mortgage insurance, it will automatically drop off. And that automatic cancellation happens if you want to know more about that, definitely watch the video I'll link above here with regard to canceling single mortgage insurance. But the automatic cancellation takes a while, and the single mortgage insurance premium relative to what would happen if you did nothing, sat back, let nature take its course, and let mortgage insurance drop off automatically, the single mortgage insurance is a heck of a good deal. And in every single instance, you're going to see that it's much less expensive than what the single would be. But you're not going to want to sit back and wait and let nature take its course and let your mortgage insurance premium drop off automatically. As your property value increases, as you make improvements, maybe you pay additional money to the principal on your mortgage, you're going to reach a point where you're eligible to request an early cancellation of your mortgage insurance. Now, from 1992 to 2023, home values in the US have appreciated at an average of 4.58% per year. So I used that rate of appreciation and calculated, well, gosh, how quickly could you get rid of mortgage insurance? When would you get to a point where you'd be eligible? And it would take 55 months if you were putting 3% down. So now we're getting pretty close. You're paying just a little bit more in single mortgage insurance, just a little bit more in the monthly mortgage insurance than you would in the single, but the single's still a little better deal. And you'll notice that actually flips. If you put 10% down, then the monthly mortgage insurance could be less expensive. Now, this is a projection. What your home appreciation is going to be, what you'll pay toward the principal, any improvements that you make, and so on will play into this. But the other thing that we want to think about, because as I'm recording this, interest rates are pretty elevated, is that you may not have this loan very long because you may refinance it. And if that's the case, then this comparison is less important than this next comparison, where if you refi, let's say 2 years after you purchase your home and you paid monthly premiums, those monthly premiums would add up to a lot less, really less than half of what the single premium would be. So when you're thinking about, are you going to spend a seller concession on mortgage insurance, you have to think about how long you think you're going to carry that mortgage insurance. If you're going to be lazy and let it drop off, the single MI is a super good deal. Or if you don't think your home value is going to appreciate, if the home value is going to appreciate nicely, then it's a little bit of a toss of a coin. But if you think you're going to get to a point where you're going to cancel the mortgage insurance or pay the loan off early, refinance, then the monthly mortgage insurance is probably your better bet. Now, I want to jump into some case studies, like I said, to talk about all the other ideas that kind of bring together all the other ideas that we spoke about earlier. And I used real world examples of real clients, but I did change their names for privacy, of course. So first, we're going to talk about Marge and Homer's home purchase. They found a great townhome they absolutely loved. The asking price was $450,000. It had been on the market for 60 days, a little while, and so their real estate agent thought they could get $12,000 of concessions, and they had $77,000 of cash to spend and really, really wanted to keep their mortgage payment to $2,800. And for the numbers that we're going to be looking at, you'll see I'm making some assumptions for taxes and insurance. These were pretty close to this actual property. And let's look at some numbers and figure out how can we spend this seller concession and get the best bang for our buck. Well, for a point of reference, we want to talk about what would a full price offer look like. So if they offered $450,000, the seller's asking price, and used their $77,000 to go toward the down payment and all closing costs, they'd be looking at the interest rates when they purchase this property, a total monthly payment of about $3,000. That is more than they want to be paying. Remember, their target is $2,800. So what happens if we take that $12,000 that their broker thinks the seller will concede, and we apply it to just a straightforward, simple price reduction? Well, that'll mean the price is $12,000 less, $438,000, and they can put $12,000, that $12,000 of savings, into a bigger down payment, and staying at that same amount of cash that they've got, because that's a fixed number. We're going to lower their monthly payment by just a little bit, about $80. Not a huge amount. We're still over their $2,800. So what happens if we apply this to a closing cost credit? Well, now we're not taking it off the price, so the price is back to $450,000. The loan amount's actually the same, and that's because the money that the seller is paying as a credit to offset their closing costs, they can now pay as a larger down payment. We're still sticking to that same $77,000. Now, the interest rate's the same, so it might surprise you to see that although we're still over their $2,800 target, we're saving just a little bit more, about $9 extra on their monthly payment. And the reason for that is on the earlier slide. The mortgage insurance is tiered based on how much you're putting down, and that extra little bit of down payment was just enough to notch them into a lower mortgage insurance premium, which knocked some money off of their payment, but still didn't get them to their $2,800 target. So let's dip into some of our other ideas and have them pay points and buy out mortgage insurance with the seller's $12,000. So we're going to leave the price at $450. We're not going to do a price reduction. The loan's going to be a little bigger because we're not applying it like we did in this example to credit closing costs. We're actually creating some closing costs by having them pay points and a single mortgage insurance. We're still at $77,000 out of their pocket, but we were able to lower the interest rate by 0.5% down to 6.25. And by getting the mortgage insurance out of their monthly payment as well, we nailed it, and we got ourselves from $3,000 down to $2,799, just under their target monthly payment. And again, that's using single mortgage insurance premium and having them pay some discount points with the seller's money. Now let's look at Bert and Ernie's home buying adventures. So they found a house they were super excited about at $575,000, and they're both educators, so they get structured annual contractual raises. They again found a house that was on the market for a little while, and their broker thought they could get $15,000 worth of concessions. This house is a little bit of a stretch for them, and it's a little bit better than a starter house. So, they're hoping they can be in it for a few years, but it's going to be a stretch for starters. So they want the lowest possible minimum monthly payment. And they are optimistic. They were optimistic when they bought this house earlier that they would be able to refinance and lower their monthly payment before too long when interest rates go up. So let's look at our other assumptions. Of course, we've got to make some assumptions for taxes and insurance. I rounded a little, but these are very close to what they really were for the property that these folks bought. And they had between $70,000 and $75,000 that they could put toward their home purchase. So again, let's get our point of reference for a full price offer. At $575,000, with their available cash, they'd be looking at something right around a $4,000 monthly payment. And they wanted to minimize that as much as possible, get that as low as they could. So let's compare what happens if, hey, we just take it as a price reduction, knock the price down to $560,000. That means the loan amount is going to be a little bit lower. Again, we're working with a kind of in that $70,000 to $75,000 threshold, same interest rate, and we're able to shave just a little bit off of the monthly payment, like $90. And again, it's just not a huge bang for your buck when you reduce the price. You get a little benefit, but nothing crazy. So let's see if we can get further with discount points. And remember, this is a non-refundable cost, but it is a permanent reduction to the monthly payment on this loan. So we're going to go back up to our $575 asking price, and we're going to have them borrow the same amount of money that they would have at a full price offer, but apply the seller's money toward buying a lower rate. And we can get the interest rate all the way down from 6.75 to 6% for the note rate. And that puts a pretty decent dent in their monthly payment, $254 off of their monthly payment, which isn't too shabby. But remember, they're optimistic that interest rates are going to come down and they're going to be able to refi. And that huge amount of money that they paid, $15,000 in points, is not money they're going to be able to get back. And so instead we thought, gosh, maybe we should look at a 2-1 buy down. We leave the price at $575,000, the same $517,500 loan amount. It's actually a teeny bit less money due at closing in this example. And that's because the $15,000 was a little more than we needed for the 2-1 buy down. So there was a little bit of seller concession that wound up, the overflow seller concession in a sense, winds up being credited toward closing costs, which reduced their closing costs just a little. Now we're back at that 6.75 note rate, just where we would have been with a full price offer or with a price reduction. But remember, we're going to stair step through monthly payments that'll start 2% below that 6.75 initial interest rate. And that's going to bring their initial monthly payment way, way down to $33.51, $657 less than they would be paying for the full 6.75 rate for that first 12 months. And then in the second 12 months, they're at $36.72. And that lowers their payment by $336. And in year 3, they're back up to that full $4,000 monthly payment. But remember, they're educators. They get annual raises, and they're planning ahead and stair-stepping into their monthly payment in a way that's much more comfortable for a home that was initially a stretch. Now, they're optimistic that they hope they can refi. And of course, there's absolutely no guarantee that that's going to happen. But what if in, somewhere in that initial few years, they get the opportunity to refi? Well, if within the first 3 years, let's say 36 months out, rates drop and they can refi to 6%, let's say their home value doesn't even change. If it does, if their home value goes up, they could potentially benefit in other ways. But if their home value stays just the same, they would have paid the loan down a little bit. They've been paying on it for 3 years. So their new loan would be a little over $500,000. They would have no money due out of pocket because they are going to be able to fold their closing costs into the new mortgage. And at that 6% interest rate, what we're crossing our fingers for, they could lock in their monthly payment at something pretty close to their year 2 payment. And hopefully, fingers crossed, that's going to be feasible. It'll save them about $300 off of what they were initially paying. Now, of course, this is a big question mark. We don't know what interest rates are going to be in the future. So it's really important if you're doing a 2-1 buy down, and that's how you're applying seller concessions, to plan around that monthly payment. You're going to be where you would have been without a concession after the scheduled buy down period. So let's look at our third case study for Thelma and Louise. So they're tight on cash. The first 2 case studies we ran through, we're trying to minimize the monthly payment. Now we're going to try to leverage a seller's concession to reduce money due at closing and maybe do one other thing. There's a little bit of a plot twist. It is Thelma and Louise after all. So they have saved up $15,000, not a ton of money, and they have a family member willing to chip in another $10,000 if needed. They're not crazy about taking their generous family member up on that offer, but it's there if they need it. And they're looking at homes in about a $500,000 purchase price, but most of what they're seeing in their price range is a bit of a fixer-upper. So they're concerned, they're flexible about their monthly payment, but concerned with having some money left over to make improvements after closing. And of course, we've got to make some additional assumptions about taxes and insurance. So here those are. And they're planning on putting 3% down, which is the minimum for a lot of first-time home buyers. So as our baseline, full price offer with $500,000, if that's what they wind up buying, with 3%, $15,000 down for their total funds due at closing. And this property was, just for reference, in Washington State. Property closing costs vary a little bit from one state to another, but this was in Washington. They'd need about $25,000 to close, so they've got to take up their family member on that generous offer. At the interest rates available when they're shopping, their total mortgage payment would be about $4,000. And we want to try and minimize their money due at closing again, remember, so they have some money left over to fix up the property afterward. So what happens if we do a price reduction? Well, they could knock the price down with a $15,000 seller concession to $485,000. Their 3% down is going to be just a little smaller. The loan amount's going to be just a little smaller, but they are reducing their monthly payment or their money due at closing by just the tiniest amount, and the same thing with their monthly payment. They're reducing their monthly payment by about $100, and they only have $540 less due at closing. That is not going to leave them a lot of money to work on a fixer-upper. So what happens if we have the seller pay their closing costs? Take the price back up to $500,000 and take that credit from the seller, 3% of the price, to offset closing costs. Well, the least amount of money the Thelma and Louise can pay is 3% down, their minimum down payment on the home, which is $15,000. So there's really only about $10,000 of costs that the seller could pay for them. The sales price or the monthly payment is going to be the same because, again, the price is the same, the down payment and loan amount are the same, but we have reduced their cash due at closing by about $10,000. They've got $15,000 due at closing, the absolute bare minimum, 3%, and they have $10,455 that the seller paid for them. So that gets them a little chunk of money, a little nest egg to work on the property after closing. But we could maybe even take this a little further because remember, the seller can pay up to $15,000. We're only spending $10,000 here. So what if we also have them at that same $500,000 purchase price, the same 3% down, ask the seller to chip in on a point as well, buy their interest rate down? Well, that would get them a 0.5% reduction in their interest rate, and that's going to lower their monthly payment nicely, another $165 savings, even more than the savings that they would have gotten if they'd taken a price reduction, use the seller concession to reduce the price, and they also have $10,000 less due at closing, which is going to leave them with a nest egg to work on the property and a lower monthly payment. We're really maximizing the benefit for that $15,000 that the seller's going to concede. The other thing that they could potentially do, remember we talked about mortgage insurance premiums are lower as you put more down, is maybe have the seller pay a credit to some of their closing costs so that they can put 5 instead of 3% down. And if they do that, that would drop their loan amount to $475. They're back up to $25,000 due at closing, so they're not going to have money left over to work on the property after they close. But the point and the lower mortgage insurance premium and the lower loan amount conspire to make the monthly payment lower yet. So if they were looking for a lower monthly payment, this is going to save them almost $300 on their monthly payment, but really not take much off of that money due at closing or leave them with money to work on the fixer-upper. Now, there is another fun way that we can leverage, and I alluded to this when I was talking about things earlier. We can leverage a seller credit to make a down payment larger, and this is one example of doing that right at that $500,000 sales price. But here's another possibility. These folks are flexible on their monthly payment, so what if we increase their price and have them look at properties that are more expensive but not a fixer-upper, something that's going to be in good shape that isn't going to need a lot of work after closing? If we take their price up a whole $100,000, go back to 3% down, we can get them into the property with $25,000 out of pocket, the maximum amount they have available, and buy their interest rate down a little bit as well. They're going to have a bigger monthly payment. They're going to be paying $423 more a month if they go this route, and they're not going to have any money left over to fix up the property. But if this is a property that doesn't need work, it's in better condition, maybe it's in a better neighborhood or a property that's going to appreciate better as well, then this could theoretically be a better investment. So this is a way that you can leverage a seller concession to increase your buying power if that's something that makes sense. And that wraps it up. Thanks so much for watching. I hope you found this a helpful tour of seller concessions, the things you can do with them, how you can leverage a seller concession to benefit you. And if you're a seller, I hope this gives you some ideas for how to market your property with an efficient use of some concessions that you could give to your buyer. Please take a moment to like and subscribe and check out my channel for more mortgage education. Thanks for watching.